Welcome. My name is Darryl Nagel, and today I want to talk about a very important topic: make trading your business. Many traders say to me that they really want to turn their trading into a profitable business, and so I want to give you some ideas that may be able to assist you. So to make trading your business, you really need two important aspects to consider. The first is to have an edge. The second is to trade in accordance with the law of large numbers. So let's clarify those terms. So first of all, you need to have an edge. And what is an edge? It's really a mathematical calculation of the results of your trading plan. So hopefully you've got a written trading plan, and that would take into account your entry rules, your risk management, and you're able to ascertain without any doubt whether you've got this what's called an edge. Because actually if you don't have an edge, you're really gambling. And so that's not what I know you want to do. And so what is interesting is that the ACY has a trading cup, and you'll see with that trading cup competition, many of the traders there have an edge. And so there's a couple of ways in which you can actually ascertain whether you've got an edge. The first is to backtest your trading plan. The ideal about that is that you can see, for example, over the last 5 years, whether or not there would have been a positive expectancy. It is important really that you go back as many years as you can with your back testing that takes into account when the market was bullish, that is the prices were going up, bearish, that means the prices are going down, or sideways, and so that's when the market is consolidating. Now, in addition to that, you really do need also to forward test, because there's no guarantee that the results that you obtain from your back testing will be replicated going forward. So I always recommend that in addition to your back testing, you actually engage in forward testing. That is, you've got your written trading plan and you're actually trading not necessarily to make money, but to ensure initially that you actually do have an edge. As I say, if you don't have an edge, you're gambling, and that's not the way to go to make money in the trading market. So what are we talking about with what we're trying to achieve? We're looking for what's called an expected result. That is a 20% profit over a period of trading. So it doesn't have to be 20%, but that's really what you're looking for. You're looking for a positive expectancy. Sometimes the term is called expected value. Today I'm just going to talk about it as expected result. So in addition to having an edge, you also need to trade in accordance with what's called the law of large numbers. Now to me this second one is really critical, because you may have an edge, but if you don't understand and apply the law of large numbers, then you may not be profitable at all, and that's not what we want. What that means for traders is that the more you follow exactly your tested and proven edge, the more it will reflect the expected value. So I'll just go through that again. What it means is that the more you follow exactly your tested and proven edge, the more it will reflect the expected result. This is very critical. This is very important, because I think when traders first start off, they think that, look, I'll trade this for say 10 trades and just see how I go, or even 20. And even 20 trades is not a sufficient number in order for you to ensure that you do have an edge. You do have to have a reasonable number of trades. Now, what is a reasonable number? I can't give you an exact number, but for me, I'd like to have, say, 50 or even 100 would be awesome. So ideally, you need to take a large number of trades so that your tested and proven edge can provide you with the expected profits. Now, trading Forex and CFDs really do facilitate you being able to take advantage of the law of large numbers. And the reason for that is very, very simple. Because you can take a small number of positions when trading Forex and trading CFDs so that you're not risking a large amount on each trade. In other words, what you're really focusing on is not to make money. That sounds weird, but initially it's not to make money, it's to gain the skill, which is important, and by taking a small number of trades, you're not risking a large amount. And so that's really what I strongly recommend. And so, of course, if you're risking only a small amount, then you'll be able to take many more trades. And so one of the advantages of Forex, for example, is you can have not only a standard lot, you can have a mini lot and a micro lot. And with CFDs, again, instead of having to buy the shares, you can buy CFDs, and that's only a fraction of the cost of buying the actual shares, if we're talking about stock CFDs. So if you only take a small number of trades, you may find that from time to time, your expected profits do not appear. And this can be shown quite scientifically, using, say, Excel spreadsheet or whatever. And I can assure you over a period of time that I've been researching this, that if you have only a small number of trades, then you may find that your expected profits do not appear. And what happens is that you give up that trading plan, and yet you may have an edge. So beginner traders may give up on their trading plan by only trading a small number of trades. For example, 20. You might think 20 trades is a large number. It isn't. It isn't. I've seen examples where there were 20 trades, and the end result there were 7 winners, 13 losers, and a $100,000 trading account went down to $40,000. That was not because the trading plan was not good. It was good. In fact, it had a positive expectancy. The risk reward was 2 to 1. But because the way in which the trades came out, over those 20 trades, the result wasn't what you wanted. So the solution to the problem is very simple, that you have to have a larger number of trades. It also addresses the problem that you often have, and that is the sequence of trades. So sometimes you can have a series of winners and a series of losses. We do not know. We cannot know the unknown. The markets are inherently uncertain. But you'll find that by applying these two concepts of the edge and the law of large numbers, it'll assist you. So those traders may, in fact, who only do 20 trades, may have a trading edge, and yet they give up on their trading plan and seek another trading plan, and then they may give up again on that one. I know people go from trading plan to trading plan to trading plan. So just give your trading plan a significant number of trades so that you can get that edge cutting in. So what I say is this, that if you just take 20 trades, you are less likely to achieve your expected profits than if you took, say, 100 trades. And that's why I really like Forex and why I like CFDs. And just for those who might like to do some research, here is a photo or a depiction of Girolamo Cardano. And in the 16th century, he revealed the law of large numbers, but he wasn't able to provide a mathematical proof. But in 1713, a Swiss mathematician, Jacob Bernoulli, he did provide a proof of the law of large numbers in his book. And so I just want to end by saying that if you want to make trading your business, ensure that you've got an edge and ensure that you take a significant number of trades to allow your edge to cut in by following the law of large numbers. And in doing that, I believe you're putting the odds in your favour to make trading your business. Thank you and happy trading. Bye now.